we're not to a viable bottom yet. So again, I would use this rally that we're having right now. Ever since Monday, the market's been rallying back. Use that rally, rebalance risk, reduce exposure to positions that are overweight, extra risky, whatever they are.
Welcome to Thoughtful Money. I'm its host and founder, Adam Taggart, welcoming you back here at the end of another week for a weekly market recap featuring my good Nipponese friend, Lance Roberts. Lance, how you doing?
I'm doing just fine.
So Nipponese, and I hope I pronounced it correctly, is another adjective for Japanese. And this past week has largely been all about the unwinding of the carry trade. So I thought that was an appropriate adjective for you, especially since you put out a couple of videos, very good videos, dedicated to explaining what the carry trade is and what's been going on. Why don't we just dive right into that?
Okay.
Is that still driving the action? If so, I know I've seen some competing estimates as to how much of that carry trade remains to be unwound. Do you think that that's still going to pull prices down, or perhaps have we hit bottom? What do you think?
Well, so a couple of things. So just first of all, just a very simple explanation, and this is a very basic explanation. The carry trade is a lot more convoluted, whether you're using, futures, options, and, contracts and all these other type of things. So just very basically though, what happens with a lot of Wall Street, and this has been, by the way, this has been going on for 20 years. This is not new. It's also about a $20 trillion trade altogether, and we'll talk about the importance of that number in a moment. But basically what happens is that for a decade or more, Japanese bonds have been yielding basically close to zero because they're running about 230% of debt to GDP. They have very slow economic growth. They have demographic issues. They have a major pension issue, just like we have here in the States. They're just advanced about 20 years of where
Right.
we're ultimately going to be.
So basically, because they have so much debt relative to GDP, they've got to keep their interest rates really low, or else the debt service just crushes the economy. So that's why they've had to keep.
But remember, they're not keeping their rates low. They want to get their rates up. The economic environment that they've created for themselves with the debt is what suppresses the interest rate, right? They're doing everything. They're trying to figure out ways to hike rates. They're trying to figure out how to get stronger economic growth. They've been buying, the Bank of Japan's been buying equities. They own 80% of the ETF market. They're doing everything they can to try to keep the game on life support. And this is why, really, ever since the turn of the century, we keep hearing this term of Japan is basically a bug in search of a windshield. It just hasn't hit it yet, right? So, and this can go on so much. And this is why, when you hear arguments about, oh, the debt in the United States or the deficit in the United States, it's this huge problem and it's going to lead to this massive economic collapse next week, next month, whatever it is, the calamity is here. All you have to do is just take 2 minutes of your time and go look at Japan. You will be amazed at how long economies can run with major debts and deficits, much longer than what you would logically expect it to do. And there's a vast difference between Japan and the United States as well. I mean, Japan has 230% debt to GDP, 240%. We're somewhere around 120. So we've got a long way to go to catch up with Japan at this point. So again, this is why it's always important not to extrapolate the debts and the deficits into meaning that markets are going to do X or this is going to happen to Y. What you can extrapolate from that is that you're going to have lower rates of inflation, lower rates of economic growth. You have a suppression of economic prosperity. Those are all the things that result from a heavily indebted economy like we have now and like Japan has had for the last 30 years. So,
Right. So just to your point, we shouldn't be aspiring to Japan's trajectory.
well, yeah, of course not. I mean,
Yeah.
who would want to, right? I just posted a piece this morning on our website talking about UBI, which is Universal Basic Income. And there was actually a 3-year experiment of actual UBI. And for some residents in Texas and Illinois, they actually got checks from a trust for 3 years. And so the article goes through, how UBI works, what it is, and why it fails. But importantly, in that article, we talk about in order to supply UBI, we would have to go further into debt to do that. we're already, and this is according to the government estimates, but right now we are spending 138% more than we bring in revenue. So that other 38% about, we spend everything we have coming in just on Social Security, Medicare, welfare,
Military.
debt, and the national defense. That's our mandatory spending. All the discretionary spending, comes out of issuing more debt. So, until you solve your spending problem, that's going to be your bigger issue. But that's going to suppress. And this is why also I've been arguing over the last 2 years, with you and others that are talking about, oh, inflation's going to have to keep going up. And because we have this much debt, interest rates are going to go up. That means inflation has to go up. And we're going to have this 1970 styles inflation. I kept saying, no, we're not, because of the debt. The debt itself is disinflationary because it leads to lower rates of economic output when that debt is used for non-productive purposes, which is exactly what we use it for. We use it to pay for Social Security, Medicare, welfare, etc. So back to the story of what the yen carry trade is. So now that you understand why interest rates are zero, what has been the trade for 20 years is that essentially I short Japanese bonds. So I sell $10 million worth of Japanese bonds that I don't own. I get $10 million. So I'm a hedge fund here in the United States. I turn around and buy $10 million worth of US Treasuries where I get 4% on my Treasury. So now I get the spread in the interest rate. So I'm making money on this trade for I've committed no capital at this point. I've got nothing, sitting out there of my own. I've just shorted bonds, which is effectively a short of the yen. And I'm now long US Treasuries. So I'm long the dollar, long US Treasuries, and I make a 4% spread between the two. Easy money. But I take this one step further now. I take that $10 million, I leverage it 10 to 1 through the banking system, and I invest that into equities. And this is why we've seen such a huge ramp up in large cap stocks. They can't really do the yen, because this is done in such large quantities, it's very difficult to invest that capital into small and mid cap companies because they just can't simply they can't own enough of those shares to make it worth the trade. So this is why you've seen large cap and NASDAQ stocks in particular outperform by such a large margin over the last decade in particular, because these are highly liquid stocks. They have earnings growth. But they're easy in and easy out. I can move hundreds of millions in, I can move hundreds of millions out, and I don't have to worry about big, price movements, all at one time. So this trade works fantastic as long as the yen doesn't go up in price. That's what happened over the weekend and on Monday. Is there was a very sharp spike in the Japanese yen that required those margins, all that leverage that's sitting out there, had to be reduced. Now, as I mentioned earlier, this carry trade is about $20 trillion. So immediately everybody goes, oh my gosh, we're going to have to sell $20 trillion worth of assets, because of this yen carry trade blowing up. That's not the case. All I have to do is sell enough to reduce the margin requirement. So if you've ever traded on margin in a brokerage account, if I have 100 shares of Apple in my brokerage account, I can borrow 50 cents on the dollar of the value of that account on margin and then go buy some more Apple with it, as an example. So now I'm leveraged in that account by 50%. If the price of Apple falls, the bank's going to call me, the brokerage firm's going to call me and say, well, your collateral value is no longer what it was. Your $50,000 worth of Apple is now only worth $40,000. So your margin can no longer be $25,000. It's now 20. So you've either got to come up with $5,000 more dollars, or you've got to sell down some Apple to get that margin balance back in place. Well, when I sell Apple, of course, that lowers my margin value more, which means I have to sell more Apple. And that's why we got such a cascade of selling on Friday and really on Monday, is because as those margin calls came in, we were having forced liquidations of these assets to cover that outstanding margin call. We don't have to close out a complete $20 trillion. There just has to be enough closed out to rebalance those margin levels relative to where the yen is currently trading. And that's why, immediately Jerome Powell, the Federal Reserve, the Bank of Japan, they were on the phone with each other talking about what needs to happen in order to stabilize that yen. And and unsurprisingly, we saw a big jump in liquidity this past week. Looking at the liquidity index, we saw a big inflow of liquidity into the markets, and that helped stabilize a lot of this. that was occurring back on Monday. So a lot of that, probably about 75 to maybe 80% of that margin call has been resolved as long as the yen doesn't rise more. That's the only risk here going forward, is that the yen continues to spike further.
Okay, so let's talk about why the yen did rise. Do we know why? Was that a deliberate choice and they realized, oh gosh, this is having impacts we don't want, or was it just sort of a bug of the system?
No, Japan had talked about potentially hiking interest rates. So they, like I said, they're trying to get their interest rate up, right? Having zero interest rates is not good economically, right? And, we talk about having lower interest rates is good, but zero interest rates are not good economically. And again, it just facilitates a whole lot of other problems that occur economically when you have zero rates. So they've been trying to get their interest rate up. And so the Bank of Japan was talking about, hey, we're gonna hike interest rates. And all of a sudden, the market rebelled and said, oh, yeah, well, there goes the yen, because higher interest rates would obviously make the yield on the Japanese bond more attractive, which then closes that spread between the Japanese bonds and the U.S. Treasury. So when you start closing that issue, that causes these margin calls to come in. So as soon as they talked about hiking rates, the yen takes off running, because that's going to attract more capital into the yen as to close out those margins, or to at least reduce that margin level. That caused the yen go up, which caused all the margin calls to happen at once. And so immediately Bank of Japan came out and said, oh, we're not going to hike rates until this settles down. So in other words, they're not going to hike rates now at all.
Yeah, well, I mean, it sounds like sort of when we talk about central banks putting themselves in a trap of their own devise, it sounds like Japan is further ahead of that than everybody else, and really is sort of stuck here, right?
Mm-hmm.
If it gives any indication, it sounds like if it's going to let rates rise, this happens.
Right. Yeah. And look, and this is why, I've written so many articles on our website, talking about Japan and why we're on the path of Japan ultimately with our debt, the lost decades that Japan has witnessed in many cases because of their debt. We're doing exactly all of those same things, and so we're ultimately going to get a relatively the same result of this, because ultimately it's out there. But if you take a look back, just look at the relative increase in debt, the increase of the Bank of Japan owning assets, there is just a steady decline in the ability to maintain inflation and interest rates at non-recessionary levels. And that's why Japan rolls through recessions about every 3 years.
So the other thing I think Japan's really instructive on, because they're so much further ahead, is, as history has shown us with all currency regimes, when you get to a point where the debts have, become too excessive, the central planners start trying everything they can to try to keep the system going, and what ultimately gets sacrificed is the purchasing power of the currency.
Right.
And the yen has been showing us for a long time, but it's sort of been accelerating this year. Up until quite recently, their yen was plunging to, I don't know if it's all-time lows against the dollar, but certainly extreme lows. I hear right now it's like the best time ever to go be a tourist in Japan, because everything's so darn cheap. Which is funny, because Japan, I remember a couple of decades ago, was like one of the most expensive places in the world to go visit. So anyways, to your point of saying, hey, look, the U.S. is and many other Western nations are on the same path as Japan. They're just further ahead. So if we look at their example, one of the big questions you have to ask yourself as an investor is, okay, if the thing that's more or less guaranteed here is a continued reduction in purchasing power of my currency, how do I stay ahead of that? And Lance, you've said this many times, but I just want to underscore it for folks. That is the prime objective of today's investor, right? That's why you're investing. You're investing to keep pace with, or if you're lucky, exceed that pace of currency destruction. But that is your number one goal here as an investor.
Yeah, no, absolutely right. And absolutely, hands down, by large margins, it's been U.S. stocks that have been that. And this is not just in the past decade or past 20 years, but in the last 130 years, U.S. stocks have been the best absolute hands down hedge for the protection of purchasing power over time. Vastly vastly better by large, standard deviations of any other asset class, whether it was bonds or gold or anything else. U.S. stocks has clearly done that job the best.
Okay, and folks are going to say you're talking your book here, but I'm assuming you don't see anything right now to suggest that that's changing anytime imminently.
No, absolutely. And there's no reason for it to change. Again, there's just, a hugely different function. And it's always interesting because people say you talk your book. I don't have a book to talk. I just basically, you get me on here to talk about what we do, and that's fine. But, we invest our capital to generate returns for our clients. So that's our only interest. And I want to own the best assets for that over time. And, there's a lot of these articles that have come out here. Let me show you something real quick because I went and looked this up real quick while you were talking. Share a screen real fast.
And while you're pulling it up, just to drive your point home, you would be recommending Mongolian Quatlus if the track record was showing that they were better, right?
Well, absolutely. And again, because it doesn't matter. My job is, as we said, our jobs as investors is to invest in the best possible asset class. When you talk about talking your book, you've got to be very careful with that. See, I'm agnostic to any asset. We have a portfolio called the all-weather portfolio that owns gold in it. So I'm not anti-gold at all. We have a portfolio that owns it, and we own that for a reason in that particular portfolio model. Where you have to be careful of is when you talk to people that their business is to sell you gold, right? As an example, or if their only business, and Wall Street is a good example of this, Wall Street's business is to sell you stocks because they do the IPOs, they do the secondary offerings, et cetera. Their job is to sell you those stocks. That's how they make their money. My job is to manage money for clients. And again, it doesn't matter what asset class it is. I just want the best return over time for my clients so that it ensures that their purchasing power parity of their portfolios are there when they reach retirement. But here, real quick, before we jump off Japan, this chart's a little bit dated. This was from an older article I wrote about a year or so ago. But what this shows you is gross domestic product of Japan. And you see these kind of regular recessions that Japan goes through just repeatedly over time. The black line's the Bank of Japan assets. This is just the total assets, and they've just been leveraging up their book, owning, buying a very large chunk of the bond market, 80% of the ETF market.
Right. Sorry to interrupt, but they're like 100% of the bond market, aren't they?
Getting pretty close. Yeah, they are about the only buyer of Japanese bonds because everybody else is shorting them for the yen carry trade. So, but the yellow line is the important one, and that's the yield, right? And they just cannot get that yield off of zero because of the amount of debt that they currently have outstanding. And again, yields are relative, and this goes back to our story is that people talk about, well, this is like the 70s. We're about to have stagflation and all this other issue. Well, the reality is we don't have the economic dynamics for it that we had back in the 70s, but all yields are relative. Yields and currencies and all these other things are all relative to each other. So you're not going to have one country with interest rates taking off to the moon and every other country in the world having falling interest rates, because it would just suck all the capital from everywhere else in the world into that one country, right? So it just basically destroy economics. So yields are relative, and you can go back and look throughout history. Ever since the Japanese yield has been falling and them taking on more and more debt, the yield on the U.S. Treasury has followed. Now, why did the yield spike in the U.S. over the last, couple of years? Well, that's because of all the stimulus. We shut down the economy. We funded the economy with a lot of fake money. Everybody went out and spent it when you had no supply. So basic, economics is too much demand, too little supply. You have inflation. And now that we're working back out of that inflation process, interest rates are falling as you naturally would expect them to occur. And yields on the U.S. Treasury will revert back to the long-term growth trend of the economy and inflation, which is going to be sub 2% eventually. But we have so many things in common with Japan, from aging demographics, large import-export economies, high debt to GDP, high dependency on welfare programs, low savings rates, et cetera. The end result is going to be the same. If you repeat an experiment in the exact same environment, you're going to get the same result. And that's where we are currently in the United States. So that is all going to be ultimately how this plays out down the road. But this is something that will take decades in the making before we actually get there.
All right, Lance. Well, before we get off this, I've got one last question to you. related to this, which is, if you look at a chart of interest rates in the US or bond yields, both, but let's say bond yields, it's basically been a 40-year descent, right? And there's talk now from an increasing number of analysts that we are hitting or have hit a bottom in that secular cycle, and then we're going to have higher yields, higher secular interest rates going forward. It sounds like you would dispute that, given if we're looking at Japan.
Basically, if you take a look, going back to 1980 as an example, so Ronald Reagan took office in 1980. At that time, we had no deficit. We had, the household debt to income was about 60% of household debt to net worth. So it was very manageable at that point. Fast forward to today, it's 160%. We have a $35 trillion amount of debt on the books for the federal government. We're running 120% of debt to GDP and running a $2 trillion deficit. During that period of time, interest rates went down, inflation went down, economic growth went down, right? We peaked in economic activity. Economic prosperity in the United States peaked in 1980. Since then, after the financialization of the deregulation of the financial markets, which allowed banks to go solicit households for credit cards, ad nauseum, et cetera, we've had nothing but less economic prosperity as debt continued to increase. We increased debt by almost $11 trillion between 1980 and 2000. And that has been a major drag on economic prosperity, because the money that we make, we used to be able to spend that money that came into our household to start businesses or to buy products, go buy a new car, buy a house, whatever it was. Since then, we now have a big chunk of our income going just to service debt. So it's non-productive outflows of capital that used to be productive. So the theory that, debts and deficits are inflationary hasn't been correct in 40 years.
Yeah. Okay, Lance. Well, what's depressing about that, right, is basically to reverse that trajectory, presumably we have to take on less debt, at least less debt, less quickly, which means we have to not be running deficits. And of course, we're doing the exact opposite. And we've talked many times on this channel about how the percent of the deficit to GDP is an extreme right now. It's near where it's been only in times of warfare, where the entire country was mobilized around World War II or World War I, right? So we have a political base that is extremely adept at spending more money, right? They do not have the musculature nor the mindset for the reverse, right? Which is austerity, which is what we would need to have some form of to try to do more with less, or just try to do with less going forward. So the problem is, I don't see any of this changing until we basically have a clearing out of our entire political fleet. And I don't see that happening willingly. So anyways, it kind of makes one's depressed if you're looking for different behavior or different trajectory going forward.
No, but the problem is, and this was, again, this goes back to our conversation about, the best asset for protecting your dollars in the future. And again, so let's go back to our basic premise of, why do we invest? Our job is to make our money grow as fast as possible. And again, lots of asset classes to choose from, lots of bad narratives. But just as an example, this is kind of what you're talking about here in particular, is that this is the chart that I was talking about. This is from today's article on UBI. And this shows you kind of where your tax dollars are going. So out of this, we're spending 138% of more than we bring in revenues. We spent 6.6 trillion. We brought in about 4.4 trillion. This is where it all goes. Most of this, about 90% of it, is all mandatory spending. This is stuff we have to pay, which is Social Security, Medicare, Medicaid, interest on the debt, prescription drug benefits, defense spending, right? Those have to get paid. Got to pay the military. So if you want to cut spending, you can cut all the non-discretionary spending. So we get rid of tomorrow morning, I'm president, I wake up and say, okay, we're no longer going to fund the national parks and wildlife. They're done. Department of Education, you're done. Department of Energy, you're done. Department of Health and Human Services, you're done. So basically, we just cut off massive chunks of the government. That's the only way you're going to cut spending without starting to dig into Social Security, Medicare, Medicaid, and interest on the debt.
Right.
See,
But to your point, you
that's
could
the
get rid
problem.
of all of that, which is 16% of the spending, and we're still spending over 100% of inputs.
Correct, because that's just where we are now. So the idea of cutting spending sounds great. But the problem is that we no longer operate on a budget. Since 2000, when President Obama took office in 2008, that was George Bush passed the last budget we've seen since 2008. Congress is supposed to pass a budget, the president approves it, and then we spend based on that budget. Well, starting in 2008, we just now do these continuing resolutions. And we say, okay, well, the spending last year was $1 trillion, so we're just going to do that same spending this year. Well, that's a misnomer, because that's not really true. It is that same spending last year times 8%. So they increase it by 8% every single year to cover increases in spending. So just do your math. Rule of 72 says that the spending doubles, right? If you take 8%, what rate of interest at 8%? How many years does it take to double that spending, right? So on the rule of 72, we're doubling the spending every 6, 7,
every 9 years.
Yeah. And I mean, it's just, we're just doubling it that much. So we have to keep spending more and more because the budgets are automatically increasing at that rate every single year. And that's compounded returns, right? So we're actually compounding spending. We don't compound, market returns, but we're compounding spending in the government. And that's the problem. So when we talk about austerity and getting back on budget, and it's great. I kind of chuckled to myself. When I used to do political talk radio for about 6, 7 years, I would interview all the congressmen, whether it was Republican or Democrat, didn't matter. We interviewed a whole host of them, and they were all talking about, Kevin Brady. He was the head of the finance committee, and he's talking about, we're coming up to the debt ceiling, and we're going to hold them to, this is going to be like we're going to see the whites of their eyes, and we're going to just pin them to the ground and make sure they cut spending before we approve any more. And then, of course, they immediately just roll over and they do a continuing resolution. They increase it by 8%. And say, okay, we're going to get them next time. And that's been going on for since 2008, right? And this is why it just keeps getting worse. So the idea of cutting spending and reducing our debts and our deficits, it's just not in the cards because nobody's willing to cut into the actual spending, which is going to require a massive drag on Social Security benefits, welfare, et cetera, for the average person. And you ain't getting elected if you try to do that.
Right. And this is, again, why I say it's depressing, right? Because theoretically, we could be doing things differently. Absolutely, to do them differently the way they need to be done will require a lot of pain. Not denying that at all, but we are highly likely not going to face this, at least not proactively politically, for the ways that you've talked about. If we do austerity, it's because it's going to be forced on us, and this is why I keep going back to. Then the deficits will continue, the debt will continue, and the currency purchasing power will suffer. And again, I just want to, make everybody as aware as possible that that is the game that's underway. And so you need to be asking yourself, how do I not become collateral damage to the inexorable decrease in the purchasing power of the currency? And again, that's just a huge reason why we do what we do here, Lance.
Right. And that goes, look, this goes back to what I said earlier. I know there's going to be a lot of gold bugs out there that are like, I don't agree with Lance about gold. Look, I don't care if you agree with me or not. I just look at the facts. Peter Schiff is one of the biggest gold bugs I know, right? And so he's always kind of he always posts a lot of stuff about, well, if you had, a bar of gold, it would give you this much purchasing power, and this is, how much you'd have today. So this chart is one of his examples. He said, if you own gold back in 1900 and you bought a suit back in 1900 and you put the same amount of money, which was $41.42 for buying that suit, into gold, you'd be able to buy 2 suits today. So you would have protected your purchasing power over that last 100 years, right? 134 years. But if you put the same amount, 41.42 in stocks, you'd have $31,000 on, this is an inflation adjusted basis. So you'd have $31,000 today. So what was a better, and then this is my whole point of, what was your better protection of purchasing power over time? Stocks are going to grow. They're going to go up and down in value, just like gold has gone up and down in value with the economy, what goes on. But if you measure inflation, inflation is a function of economic growth. So I want the asset that has the highest correlation to economic growth over time. And that's hands down, far and away, that's stocks.
Okay. All right. Well, look, speaking of stocks, let's get to what's going on right now. Let's pull up the S&P. You already anticipated me. Good job. Yeah. So let's go through the technicals. And again, let's address the question that's getting kicked around right now. So last week, Lance, you were saying, hey, I think this sell-off still has more legs. In fact, I think we're going to kind of more or less sell off through October. And again, you were talking probabilities. And then there might be a chance to get in and start, buying at some more attractive valuations. Some people are asking, well, do we just advance the timeline, right? Do we have a washout? Is this now time to start, nibbling? I think I've seen some of your recent tweets where you've said, hey, there might be an interesting entry point here. So did the speed of the sell-off change the game at all, or are we still in overbought conditions, but getting better?
No, we're definitely not in overbought conditions. Now, there's a couple of things that are important about market bottoms, right? So to say, are we at a market bottom? Is this the time to really start buying a lot of equities? I don't think we're there just yet, because we have not brought down consumer sentiment yet, or I shouldn't, well, consumer sentiment, yes, but also investor sentiment.
Yep.
Investors overall are still pretty bullish. They really weren't shaken out of the market too much over the last week or so. But let's go back, again, just kind of recap where we are. Back in June and July, we said, hey, we're set up here for a 5 to 10% correction. So starting at the end of July 31st, so it seems like forever, but it's only been 3 weeks. But we went from the peak of the market to the bottom of the market on Monday. That was an 8% decline. So we are right within the norms of that 5 to 10% correction. I kind of just split the baby down the middle. So since then, and you can see that on Monday, since Monday, we've had a very nice rally back. And, right now we're struggling with that very important 100-day moving average. This is the first test of resistance. Now, Adam, on Monday, when we did our live Q&A and last week, when we talked about this as well, but on Monday, when we did our live Q&A, this was kind of in the midst of this bit, or Tuesday, I can't remember what day it was now.
We did it Tuesday morning, right after Monday, yeah.
Yeah, I've slept since then, so days get past me. I talked about it, said, hey, look, we're probably going to get a rally here, but be careful because there's a lot of trap longs. And right. So as soon as these individuals get to a point where they get a little bit of their money back, they're going to hit the sell button. On Tuesday, as we were talking, the market hit the 100-day moving average and sold off. On Wednesday, we opened at the 100-day moving average and sold off all day, had about a 2% correction. On Wednesday, we rallied to the 100-day moving average and closed right at it. Now on Friday, we're trading just a little bit above that right now. So we're trying, markets are trying to hold on to this 100-day moving average, but every time we get to this resistance level, these trap longs are showing up. So the question is can we exhaust these trap longs without the market going back down again? And that's something that we may or we actually won't find out for a few days, but we are oversold enough technically for this bounce to continue. And we could potentially rally up towards the 50-day moving average. But when we get to that level, that's going to coincide with the 20-day, which is now crossed below it. So there's a lot of overhead resistance, and we got a lot of people trapped in this market that are going to look for an exit. And again, we're not really bearish on sentiment either. So we haven't really washed out a lot of those people. So again, we rally here a bit, the market starts to sell off. Then you get more panic in the markets potentially of these more bullish people going, oh, well, the market's not going to go back to all-time highs. I better get out now. So that's going to bring up some more selling. We come back down. I suspect that sometime between August and September, we're going to come down, kind of retest these recent lows, maybe set a little higher low. Potentially, we go down to the 200-day moving average. The one thing that bothers me about where the market opened or closed on Monday is it's just kind of in the middle of no man's land. It's below the 100-day and above the 200-day. There's not really a big support level at that particular juncture. So, if the market comes down to retest it, there's not a big support level there to keep the markets from going lower. But again, we did have buyers there. That was important. And this goes back to something we've talked about on the show numerous times, is that, the issue with markets, as long as everything's going up, everything's fine, because sellers live higher. So, in order for a buyer to buy something, they've got to get a seller to sell them something. And the seller goes, yeah, I'll sell it to you, but it's going to be at a higher price. So the buyers go, okay, I'll buy it at a higher price. The problem is that we get these corrections, and we saw this on Friday, we saw it on Monday, is that the buyers were there. Like on Monday, they were just 3% lower than where the market closed on Friday. So the buyers were there, they were just a lot lower. So sellers live higher, buyers live lower. And that's what we saw. So right now we're seeing this buying coming in. We're seeing, hedge funds kind of regrossing some of their portfolios for the Mag 7, in particular the Apples, the Googles, the Nvidias, et cetera. There's been a good bit of buying really ever since that low on Monday in those stocks. Eli Lilly's had a huge couple of days in particular. But again, I think we're going to run into a little bit of resistance and we get another pullback. If you look at 1987, 2011, 2015, and 2018, these were all similar events that occurred. We had a portfolio insurance blew up in 87, 2011. We had the earthquake off the coast of Japan that created a tsunami that flooded Japan, caused a nuclear reactor to melt down, that launched Godzilla. Then in 2015, we had the Fed taper. That was when Janet Yellen said, "Hey, we're going to taper what we're doing on QE," and that also had Brexit. And then in 2018, we had the Fed say, in the middle of hiking rates, they were nowhere near the neutral rate. So each one of those events led to a very negative, unexpected exogenous shock. And this is something you and I have talked about before. And again, when you listen to a lot of the media out there, or you listen to interviews with people, they give you all these reasons. Oh, I think the market's going to go down because of Israel and Iran, or China, or Ukraine and Russia, or this thing or that thing. And those things are never the event that cause a big market meltdown. The market knows all this stuff. And as soon as the market is aware of it, the market prices it in. They hedge for it. They swap out positions for it, whatever it is. But those big macro narratives that people talk about are never the event that gets the market.
Right.
What gets the market is these unexpected exogenous events that show up out of nowhere and was on nobody's playing card. And nobody expected the yen to spike. And all of a sudden, those margin calls came in and everybody had to sell at once. So buyers were like, man, I'm selling too, but I tell you what, if you get down to this level, I'll buy it. And that's what you saw happening on Monday. But these are the things that, make it difficult to manage money, because these exogenous events, 87, 2011, 2015, 2018, good examples, exogenous events out of nowhere called a very sharp market break. And then markets recovered and started going back up again. So we're going to get through this. The bullish trend is still very much intact. We have a couple of big events coming up that can certainly add some volatility to the market. We've got Jackson Hole Summit coming up at the end of the month. If the Fed right now, markets are kind of starting to price in a 50 basis point cut in September. That's not going to. I don't think that's going to happen. I think that's a very small probability event. If the Fed only cuts 25 and remains a bit hawkish, that could be a negative shock to markets. The election is still a risk coming up. Kamala now with Harris and Waltz versus Pence and Trump. The outcome of that election is very much kind of up for grabs at this moment. Polls have tightened up a lot. Economic policies could not be more different between the two parties. So there's a big likelihood that in the next 89 days heading into the election that we're going to see potentially the market try to de-risk a bit, going into that election, just not wanting to be too long equities, unsure of actually who's going to win. There'll be a lot of bets about who's going to win the election, but you never know until the votes are over, right? Until the votes are counted. And we've seen that previously. So again, I think there's a couple of events, and you go back and again, look at those four sequences, 87, 11, 15, and 18. Every one of those had a very sharp down break, just like we just had, a rally back that retraced about half of the return and then came down and either retested lows, set new lows, or set a higher low. And that was your buyable bottom. So we're not to a buyable bottom yet. So again, I'd use this rally that we're having right now ever since Monday. The market's been rallying back. Use that rally, rebalance risk, reduce exposure to positions that, are overweight, extra risky, whatever they are. It's okay to add some positions. We've added a couple of positions over the last 2 weeks to our portfolio. We bought some Costco earlier this week. So you don't sell everything, be selective, because there's some good opportunities in the market that the market's giving you as well. But overall, we want to raise cash a little bit, be a little bit less risk averse. Bonds have been doing a great job. You and I talked on Tuesday that the bond, you couldn't, and I think I mentioned this even on our interview last week, is that bonds were too overbought to buy. They've had a big correction this week, coming back down. We got close to our target was 4 to 4.1%. We're kind of right there right now at that target. So bonds have retraced a lot of that recent overbought condition. So those are becoming a lot more appetizing, but they've had a very negative correlation to stocks over the last week, which has done a great job of hedging portfolios.
Okay. Let's see, a couple questions for you. I guess let me go to the big one first, which is sentiment. So you mentioned that we haven't yet seen, any real washout in investor appetite for risk right now. I guess where I'm going with this is I've been noticing now, both interviewing some folks and watching on Twitter, I am seeing some folks that are in the capital management business, start to say, hey, look, we're adopting a more neutral stance going forward. So here's a tweet from Katie Stockton of Fairlead Strategies. This tweets from a couple days ago, from yesterday, I think. Today we move to a neutral long-term SPX bias for the coming months after having been bullish since late 2023. All right. And I interviewed Darius Dale yesterday. And that interview, by the way, folks, great, chock full of data, the way Darius always is. That's coming out tomorrow, the day after this video airs. But Darius is also seeing a change of regime. And folks may remember that the previous 2 times I've interviewed him, right before Q1, right before Q2, he was saying his model was extremely bullish heading into Q1 and still quite bullish in Q2. It is not quite as bullish now. So my question to you, Lance, is, if Wall Street in general, if sentiment is now beginning to move away from bullish, I'm not saying bearish yet, but even just bullish to neutral, how does that factor in here?
Well, I mean, look, again, it's all about sentiment. So, you take a look at, like, for instance, on the chart here. So we run all kinds of different sentiment indexes at simplevisor.com. So we measure strong buy, sell ratios, historical investor sentiment, kind of multiple different measures. But the 2 that we publish in our newsletter every weekend is the fear greed gauge, which is based on allocations. So this is very different than CNN. So CNN is basically looking at the S&P and saying, okay, is it overbought, oversold? That's greed and fear. And a few other indicators, but it's very much tied to the S&P. This has nothing to do with the S&P. The S&P isn't part of this analysis. It's how are people allocated. And again, you go back to October of 2021 or 2022, when we were at the market bottom, we were very negative on that sentiment, and we're only now back to flat. So, people are still very bullish on the market. So technically they're neutral at the moment, but they're not really bullish. They're not really bearish. Technically, we're still, very overbought, and this is a weekly gauge. So these technicals move a lot slower. But again, you go back to look at where we were in October of 21. Technically, we were extremely oversold on weekly indicators versus kind of more neutral where we are now. So again, we haven't washed out that bullish sentiment at the moment. So that's what I'm saying. Another couple of weeks, if we go through 2 or 3 or 4 more weeks of, flat to down markets, a lot of volatility up and down, you're going to get investors very negative. Remember last October, we went through that 10% correction last year that took 3 months. And by the time we got to October of last year, sentiment was very negative. People were very, headlines were, the bear market's back, and we're going lower from here. And I wrote the article saying, hey, no, we're probably gonna have a bottom here. We're rallying to the end of the year. We got buybacks, earnings, all these other things. And we had a very nice rally in November and December. So we're not quite to that same setup yet. And that's why I'm saying that, where we are now, likely markets are going to struggle here a bit over the course of the next, couple of months as we kind of wash through this process. But at the end of the day, this is going to come back to two factors. What sectors of the markets can grow earnings and what sectors do buybacks? And, that's what's going to drive the markets going forward from here. And so when you take a look at small cap, mid cap, large cap, which of those three markets generate earnings growth? 100% of all the earnings growth is coming out of large cap stocks.
Yeah.
Right? Small and mid caps don't do it. Which of those stocks do the most buybacks? That's large caps. Large caps have made up 100% of the net equity purchases since 2000 of the market. So it doesn't really matter what retail or institutions do. Corporations, if they're, from 2000 to present, there's been a negative growth in assets of households and institutions in a lot of cases, once you net them all out, foreign buyers, domestic buyers, et cetera. All of the buying has basically come from corporations, and that's accelerated dramatically over the course of the last decade.
Meaning buybacks, when you say all the buying?
Yeah. They're through their buybacks, yes. And look, Apple's going to make up almost 13% of all the buybacks this year just by itself.
Yeah, crazy. A company that's not growing revenues, by the way, but hey.
Yeah. But again, if I don't have to grow revenue, if I can just buy back my stock, right?
Yeah, which is just crazy, but all right.
Hey, real quick, just having said that,
Yeah.
look, none of this means that we can't have a decent correction at some point. A 20% drawdown, certainly possible. You need a bit of an event for that, whatever it is. It's not just going to materialize. You'll need, if the yen keeps spiking, you're going to get a bigger sell-off because you're going to have to unwind more of that yen carry trade. If you have, some unexpected, outcome of the election, right? Or let's say the Fed comes out, another good example. The Fed came out at the end of the month and says, yeah, we're not cutting rates at all. That could probably lead to about a 10% cut because the markets are really looking for those rate cuts right now.
Yeah. All right. Two more questions for you, then we'll move on. One, can you pull up the S&P chart again, just for a sec?
Of course.
I want to talk about a technical indicator here and what weight, if any, you put on it. So if I remember correctly, yeah, it looks like the 20-day moving average has just dipped below the 50-day moving average.
Yeah, right? That's right.
Yep, and it's too early to. It's too early to make, I think, any conclusive calls on this. But I'm just looking at previous sections here in the chart that, in general, tended to precede a bit of a market fall, different sizes, and it's not a crash predictor or anything like that. But does that, if that continues, does that change in trend mean anything material to you?
Well, no. Look, the 20-day is going to cross below the 50. So if we just look back at, kind of a couple of previous periods here. So, again, I said this earlier, is that if we can get above this 100-day moving average, which on Friday, we're struggling with it right now. The sellers are, at the moment we're speaking on Friday, sellers have shown up in the market. S&P's a little bit negative, right? So we're just flirting with that 100-day moving average. We've been unable to get above it all week. It's providing a fairly formidable level of resistance where buyers and sellers are meeting, at this certain juncture. Assuming the markets, and this is what I said earlier, assuming the markets can get above this 100-day moving average, that we're going to run into this resistance on this gap, right? We've got to fill that. We've got two gaps right ahead. You've got the gap between the 100-day moving average. And here, let me zoom in just a little bit on this and maybe make this a little bit easier to kind of see. Okay. So as you can see, there's this gap that's going to have to fill between the 100-day moving average and the bottom of this we gapped lower on Friday and then closed lower than where we gapped open. And so we've got to fill that gap. And then you've got to fill this gap all the way up to the 50-day moving average. When it gets back to there, you're going to run right into the 20-day crossing below the 50. So now you've got, there's a single concrete wall that we're trying to get through at a 100-day moving average. You're running to a still barrier at that point, right? So it's just going to be a very, very tough level of resistance. There's going to be a lot of buyers and sellers all focusing on those levels that we're seeing right now. So again, if we kind of go back, and again, kind of going back in history a bit, when we did this back in April, we were talking about a 5 to 10% correction back in April. We got the 5% rally. So we came off the 100-day moving average. We didn't break that one before. Rallied to the 20-day and the 50 right where it crossed, failed, came back down, retested support at the 100, then broke above it. That was the failed test of the 100 successfully, and that set up the bottom for the market, and then buyers came back in. Same thing back in last year. So let's go look at last year. So this is July through October of last year. Came down, broke the 50-day moving average, tested the 100-day, rallied back to the 50-20-day crossover, failed, came down, rallied above it. Thought we were all clear at that point. And then we came down, flirted around with support. Everything was okay. Then we broke it again and headed lower through the rest of summer, into October, rallied back in late September, ran into that overhead resistance again at the 50 and the 100 now crossing. So now another formidable level of resistance, came down, broke the 200-day, formed that bottom, and then that was kind of all she wrote at that point. We had washed out sellers. Everybody was extremely negative. Allocations had gotten extremely negative at that point. So you had
scared a lot of people. Yeah.
Right. So we had the perfect buying opportunity at that point. That's why I wrote that article about, why we'd have that end of the year rally, is because you had the perfect setup for it after that 10% correction. Very oversold on the MACD basis and a variety of other levels. We're not there yet. So to your point, that 50-20-day moving average crossover is going to be very important resistance in the short term to a rally. And every time we try the initial rally to that will most likely fail. That's what I'm saying. Use rallies. This is an opportunity to reduce risk. And that doesn't mean sell everything, but think about taking profits. If you've got stocks that aren't performing, they weren't performing earlier this year, they probably underperformed during the recent decline. That's a good indicator that there's something fundamentally wrong with that company. Got to let it go. So let those companies go. Sell those, raise some cash. Use them for tax loss write-offs later down the road. Stocks that are doing well, don't sell those. If they're doing well, they're doing well for a reason. They probably had a recent pullback. But again, those, if they're in nice, positive, bullish trends, those are stocks you want to hang on to, not necessarily add to them just yet, because again, we're probably not through this corrective process, but those are positions you probably want to hold on to, particularly if they pay a dividend, keep that income flow coming in the portfolios. Fundamentals matter a lot right here. So make sure the companies you own have good, solid fundamentals. Are they growing earnings? Or do they have, are the valuations somewhat reasonable? Is there some measure for that? Look for those things to make sure that you've got good quality positions in your portfolio as well to navigate through this. And then, come out on the other side, you'll be in a lot better position. And also don't forget, bonds are a great hedge.
All right. I think those are all great key takeaways from this. Let me just make this statement, and you can qualify it any way you like. But what I'm hearing from you is, hey, we got some technical resistance that's building that we got to pay attention to for all the reasons you just mentioned. We have sentiment that is starting to cool from what I mentioned earlier and what you showed with the fear greed index there. Right. Again, it's not a violent lurch to bearish. It's just becoming less bullish. Mm-hmm. I got to imagine both of those things make the markets more vulnerable to a surprise should a surprise occur. Would you agree with that?
Yeah. Absolutely. Yeah. And so, so here's how, the way it works is that when everybody's super bullish, right? Like we were back in June and July. And this is why in June and July, and I wrote about this repeatedly in our weekly newsletter saying, hey, be a little cautious here, take some profits. And in July, we were really suggesting hard, take profits, rebalance risk. We were doing the same thing back in July. We were selling down positions in the Mag 7 stocks, et cetera, because they had grown to be such a large position in our portfolio. We reduced those back to target weight. But when everybody's super exuberant, that's when you're at most at risk of something like the yen carry trade, that exogenous event. When you're very bearish, those exogenous events don't have the same impact because everybody's already bearish, right? It's hard to get more bearish at that point.
Okay. All right. All right. Well, look, let's move on here as usual, where I think we're at bullet point number 2. We just finished of my 12 bullet point list. All right. So one of the things that at least it was part of the narrative used for the rebound that we've seen in stocks. Now, obviously, it was probably mostly due to the central planners really stepping in and saying, "Hey, let's stop the bleeding here in the carry trade." But initial claims came in better than expected. I don't think ferociously better than expected, but they came in a little bit better than expected, and I think that was maybe a little bit of balance against the high unemployment rate that came in on Friday and triggered the SOM roll, though we're going to talk about that in just a second. So I'll let you comment any way you like about the jobs data that we came in. The only other data point I'll add to that is while initial claims were down a little bit, continuing claims still continued to rise here. And in many ways, I think that's the more important thing to be looking at, which is, hey, who's fallen out of work that is having trouble getting rehired in this environment. And as we've talked about over the past couple of weeks here, after many, many quarters of initial claims and jobless claims, really kind of not signaling any trouble, they both started to rise, but continuing claims, has continued to rise pretty steadily, and even in this most recent data has continued to rise. So your reaction to the jobs data, and again, I know you've got maybe a qualifier to bring in on the SOM roll too.
Well, no, it was just, interesting because I wrote about it last Friday, and then, we discussed it, I think, last week. And then this week, there was a couple of interesting notes about the SOM roll. But here, a couple of things. First of all, is that the economic, so, one of the reasons I talked about on the last time we had our conversation on Saturday, I said, look, next week we're going to get the ISM services data. If that comes in stronger than expected, then we're going to see this run up in yields reverse a good bit, and that's exactly what we saw happen. ISM came in back into expansion territory after being in a contraction. That's 80% of the economy. Manufacturing numbers are important, but they're only 20% of the economy. So goes services, so goes the economy. So again, nothing really recessionary there at the moment. Employment certainly weaker. We had some impacts from Beryl in that employment number. So now we've got Hurricane Debbie to deal with in Florida. That's going to probably impact some of the employment numbers as well, at least on the unemployment rate short term. So some of those indicators may not be as weak as we currently expect them, but they are weak, but they're not negative, right? And so a lot of the sell-off on Monday was driven by headlines like this. Markets reacting to, the employment number on Friday, that there's recession warning on the horizon, that type of thing. And that really had nothing to do with it at all. It was all began carry trade, because the data really isn't recessionary. Even the jobless claims numbers right now, they're still very low. There's nothing indicating that a recession is on the horizon next week or next month, right? Now, does it mean we're not going to have a recession at some point? No, that's not what that means at all. We will have a recession at some point. Even Jamie Dimon was out this week, says I can't rule a recession out of the cards, but that's not going to happen this year. That'll be next year when that happens. We're still at 3% nominal GDP growth. So in order to get recession, I've got to clip 3% GDP growth between now and that occurs before you can even start talking about a recession, because you need 2 quarters of negative economic growth. So we're not there yet. We've got a long ways to go to get there. That's going to take at least a couple of quarters, if not 3 or 4. So the real risk of a recession is probably not until 2025, but the economic data is slowing. And that's important to understand, is because that's going to have an impact on earnings growth, which is going to impact the markets.
Okay. And one thing on the SOM roll, which we were talking about before we started the recording, is, it was triggered on Friday because unemployment rose.
We thought it was triggered on Friday.
We thought it was triggered on Friday, and I'll let you explain that in a second. But unemployment went up to 4.3, and basically the SOM roll, it looks at a 3-month moving average of the unemployment rate, and if it gets 50 basis points above the lowest point of the past 12 months, that's what triggers the SOM roll. So we saw a jump from 4.1 to 4.3, as you said earlier. That part of that jump from 4.1 to 4.3 was Beryl. So, one question is it really a true triggering of the SOM roll if that was an exogenous thing like a hurricane that just, push people out of work temporarily, but they're going to come back, once they rebuild from the storm. TBD. I just want to note for folks that it might have been a premature triggering of the SOM rule, but then there's a question of, did the rule actually truly get triggered? So why don't you explain that?
Well, so again, when we were looking at it, and I'm guilty of this too because I wrote the article, but I was looking at the data at 2 decimals, and if you take it out to 3 decimals, if you have 2 decimals, you're rounding up the third decimal, and so rounding it up on 2 decimals made it trigger. But if you took it to 3 decimals, it actually didn't trigger. So it's very close, right?
So it's like
Technically,
49.994 basis points.
exactly. Like we're there, but we're not quite there yet. So technically it did not trigger. But again, I think we've got just even Claudia Som came out and said in an interview earlier, I think it was earlier this week, that she didn't think it was a valid trigger at this point either, just because of the way things are going. Again, we got to be careful with this, and that there's 3 things to remember about economic indicators. One, they're a big lag. So it takes time for the actual data to really reflect what's going on in the economy because of the lag that we have in a lot of this data. The accuracy of this data is somewhat suspect because a lot of this is surveys, telephone surveys, online surveys, et cetera. Which there's a lot of mathematical adjustments that go into these things to make, how we come up with these numbers. So, influences like Beryl or Debbie or a state like California not reporting jobless claims 1 week can have a big impact on what those numbers actually mean in terms of recession. But most importantly, remember that when we're looking at indicators, and this is the most important thing, whether it's the yield curve uninverting, whether it's the leading economic index 6-month rate of change, whether it's Fed cutting rates, whatever it is, these indicators historically have an almost perfect track record of saying, yeah, the recession started right there. We didn't know that though for 9 or 12 months later, because remember, when you look at a chart with those recession gray bars on it, whatever it is, we didn't know that recession was there until 6 or 12 months later when it was actually announced, recorded, and then we could put the gray bar on the chart. So while it may look like these indicators are telling us a recession is starting today, we may not know about that for 6 or 12 months from now. So if we look at the data where we've got to go to, we may not actually be in a recession until first quarter of next year, but we may not know it till the end of next year. So that's the risk to being too bearish on the equity market, because the equity market's not going to look at that. They're going to look at earnings. And if earnings are growing, equities are going to go higher as long as earnings are growing. So if you really want to know whether or not to be overly concerned about the market, watch for earnings growth on a year-over-year basis not to go up. In other words, if we see if next quarter the year-over-year rate of change in earnings is slightly negative from last quarter, there's your concern. If that repeats another quarter, there's your concern. That's telling you that the economy is now impacting earnings, and regardless of whether or not we know in a recession, that rate of growth in earnings is going to tell you we're in a recession or not.
All right. So you need to come up with some sort of, basis point number there. And then we're going to call it the Roberts rule, right?
Okay. 4.99567. I'll use pi. That way we've got plenty of digits to work with.
I love it. Love it. All right. Just one thing on the SOM rule, most viewers here probably know I interviewed Claudia Som last week. Sadly, it was early last week. And it would have been so much more interesting to have interviewed her after the rule got triggered. But I was very happy to have landed her in general. And yeah, you can't always have an exact timing work out exactly the way that you want. That's the risk of being in a market susceptible media platform like this. But I did see in the comments, there were some people who reacted negatively to Claudia from her general point of view that the SOM rule was developed to provide an early indicator of when recession arrives, to then trigger policy response, right? So it basically was to say, hey, look, this will tell the the monetary and fiscal authorities that were early in entering recession. And so therefore they can do some sort of stimulus response and hopefully do a lot less than they have to do later on. And understandably, a lot of people philosophically have big issues with that. And I even probed her on this at the end, and we kind of agreed that if she comes on again, we'll really dig into this, which is okay, yes, if this tells us that we're entering a recession and we could take early action with stimulus, should we? Right? Or should we just let natural market forces take their course and stop trying to intervene, because all sorts of unintended consequences tend to result from the intervention. But other people were saying, she's a mainstream economist, and you really need to be talking to people who see life the right way. And I'm just letting people know I'm going to continue to bring on people like her, and the reason why is, like it or not, the SOM rule influences a lot of people, and it influences policy. It was created to influence policy, right? So I think as thoughtful, informed investors about what's truly going on, we have to have a good understanding of what those people who shape policy are thinking. So anyways, I always appreciate everybody's feedback, but I want to let people know, I will be bringing on, when I can, people who influence policy, but hopefully higher and higher ranking people in the establishment, again, not to embrace what they're doing, but to say, hey, look, the decisions these people make impact all of us, so let's get in their heads and see what they're thinking, so that we can then try to position ourselves for what they are most likely to do. So anyways, Lance, I just wanted to get that out there.
No, I think it's very valid, because I see one of the worst mistakes I ever do is ever read your comments on video.
Would never read comments on the internet.
Yeah. So it's the worst thing to do. But no,
I mean, I read every one, but you shouldn't have to.
Yeah. But it's very interesting, because look, I have a job to do, and I work very hard at trying to do my job the best way possible, which is to protect my clients' capital and make sure they make money. That's my whole job. That's it. Doesn't matter how I do it. Doesn't matter how I get there. My clients just expect me not to lose a lot of money when the market goes down, which we did a fantastic job of that over the last 3 weeks, and make money when markets go up. And we've done a good job of that this year too. So, my clients, they don't care how I do it. If I could do that selling used cars, they'd be just as happy with that if I'm buying stocks, right? They don't care, as long as I'm creating the returns. It's always fascinating to me, though, that, people get very defensive about their own personal beliefs. Like,
Sure.
Adam, I can't believe you interviewed her because she just doesn't know anything about anything, right? This is a woman whose job is to manage monetary policy. That's her job. So yeah, she understands exactly what she's doing very well, and she understands what those economic data points mean relative to the economy and to the output. And just because you don't like the way that she's using that data to arrive at monetary policy decisions, that's her job. Whether you agree with her job or not is irrelevant. Whether you agree with me or not is irrelevant. That's on you. So if your decisions are based on your own views, and you're getting into what's called, we've talked about this before about, confirmation bias. If you have trapped yourself into confirmation bias, well, I'm not going to listen to Claudia Sham because she doesn't agree with me. You're missing the whole point of listening to interviews with somebody like her, trying to understand, okay, well, why is she thinking that way? Great. And if that's the way she's thinking, that means that the Fed's thinking this way, which means their policy actions are going to be Y. What does that mean to the markets? I may not like it, but I better be investing the way that the markets are going to respond to those actions. And that's my whole job. My whole job is simply to look at all this data and go, how is the market going to respond to that? It doesn't matter or not whether I agree with it. There's a lot of stuff I don't agree with. And we've talked about that stuff before here on the show.
Mm-hmm.
There's a ton of stuff I don't agree with, but I can't do anything about it. So I have a choice. I can either stand here and bang my drum all day about how unfair these things are or how wrong these things are, and I can be sitting in a portfolio mostly in cash and T-bills, not making my clients any money. Or I can say, okay, I understand these things. I can go make some money, participate with that, and benefit from that. Even though I may not agree with it, doesn't mean I have to just fight it tooth and nail until I'm broke.
Well, very well said. And just my ending point on this is, I get a lot of people I get a lot of requests for, the same small number of names. Hey, you have this person back on the program, right? And I deliberately, am looking out to build the most diverse roster of what I consider to be important perspectives to bring on this channel here, because what I don't want to create is an echo chamber, which is what you're talking about there, Lance, right? Is if we only just listen to the people who confirm our existing biases, yeah, it can feel real good in the short term, but the world just doesn't work that way, and we're going to be disappointed that the world isn't unfolding the way that our echo chamber tells us it should. But hopefully all these, discussions are exciting, interesting, educational, and we're all going through this together. And again, folks, the whole mission is just to try to get the clearest sense of what the truth may be so we can make the smartest decisions. All right, Lance, let's get to your trades, and then I've got kind of a fun rant for today.
Okay. Trades this week were really pretty simple. Again, back on July the 13th, we trimmed off a lot of our, big Mag 7 stocks, et cetera. So we haven't had a whole lot to do. Our bonds have done a great job of supporting the portfolio during this recent decline. We're about 250 basis points over our benchmark right now. So we've got lots of breathing room at the moment. So what we've been doing lately is just taking opportunistic little stabs at things that we like and trimming off stocks that have gotten really overbought. So, for instance, the small mid cap stocks had that huge rally that we saw earlier, and that was a big function of that carry trade.
Mm-hmm.
When that small mid cap move started the Russell 2000 IWM, and it really started to take off. It was up like 10% over the course of a couple of weeks. That was a lot of that carry trade money chasing that return. Well, all that's gone just in the matter of 3 or 4 days. That entire sprint higher has now been completely reversed. Well, we owned a couple of small mid-cap companies that did very, very well. Stanley Black & Decker was one of those. We trimmed it previously, reduced that position after its run-up. We trimmed it again this week. It was still running a gain. So we trimmed it even more. We pulled that back to below target weight in the portfolio. And one of our long-term favorites that we've owned ever since we launched the portfolios was Costco. It's had a nice correction lately, coming up on a MACD buy signal. Love this company because they charge membership fees, and it's like an insurance, it's like an annuity. Every year on January the 1st, they open up their books and go, well, I already know this year I'm going to make X billions of dollars just from membership fees because everybody's going to renew that membership, and they keep hiking that membership due. So every year, that's just an annuity that comes into this company. So earnings have a very strong base for this company. They have much less dependency on the fluctuation of consumer demand because of that revenue base. And again, Costco's just had a great day yesterday, as a matter of fact, after we added to it. So, that's just a company that we continue to like, pays a nice dividend, great fundamentals. But again, those are companies that we kind of shore up our portfolio with. Are these companies that have very stable earnings growth, strong fundamentals, pay a dividend, and then we have a portion of the portfolio that's developed and moved towards momentum. So when markets are rising, we're participating with that. So we can increase the beta volatility of the portfolio a little bit to give our clients a little bit more return without taking on a lot of excess risk.
Okay, so it sounds like you haven't made any real big moves, but you're doing, opportunistic, nipping and tucking here, a little trimming. Maybe it's the sort of Mr. Miyagi with his bonsai tree. These are like, you got the small scissors out, just doing little things.
Yeah, but understand also too, we're 16%, well, actually we're 17% cash. We've got our weighting in our bonds, in our long duration bonds, also really bonds, as well as, kind of 1 to 3 year treasury bonds. So we've got our bond portfolio that's sitting there, and again, it's been doing well. And we're only about 53% stocks. We can go as high as 70% stocks. So we have 16% cash, we're 17% underweight stocks, and a little bit underweight duration and bonds. So we're pretty cautiously conservative right now. I would love this market to give me another opportunity between now and October to get our equity allocations back up again. I think we'll get that opportunity, but I think she's going to have to be a little patient here.
Okay. All right. Well, look, let's start winding down here, and I'm going to pull something up here, but first I want to talk about the Olympics. We're in Olympic season. I got a chance to watch a bit of the Olympics this weekend. It really is one of my favorite things in the world to watch. It's so inspiring to watch humans reach for their maximum ability to achieve, right? It is just super inspiring. Are you watching them at all, Lance?
Oh no, yes, of course I had to watch women's gymnastics. I'm a huge Simone Biles fan. Um, so yeah, I've been watching that. My favorite one so far. Do you know the story behind the shooting competition with this Turkish shooter?
No,
Okay,
no.
so it's very funny. They have all these. So in the air competition, so and they shoot these pistols, right? These targets are about this big, and they're very far away from
It's
the
amazing with pistols, which are hard to be accurate with at distance. Yeah.
exactly. So they've got all these young kids, and they show up and they're wearing these suits. They've got these glasses on that have one eye blacked out so they can look down the sight. They've got all these other gadgets. And so I don't know how true this story is, but if the story is true, it's pretty phenomenal. But for Turkey, the guy that was supposed to shoot for Turkey had to drop out for whatever reason. So they went and they just called this guy. He was like on his way to lunch. And they call him and they say, "Hey, we need you to come shoot in this competition." And he's like, "Okay, well, I'm going to lunch first and then I'll be there." And so they bring this guy over. He literally walks in to this competition. He's wearing a t-shirt and a pair of pants, has one hand tucked in his pants, grabs the pistol, was wearing normal glasses, looks down there, shoots the gun, wins silver, and walks off. Now, apparently, this guy is in the military, and there's all kinds of assumptions about what he actually does. But they said that he would have done better, but he's used to shooting moving targets versus stable targets. So again, I don't know how true that story is, but if that story is even sort of true, that is legend in my book. So
God, I'm gonna have to watch it. I love how you get these amazing stories coming out of the Olympics. Gosh, it's terrible. I'm forgetting the guy's name, but the guy that just won the 100-meter dash,
yeah,
and I think the 200-meter dash as well. Grew up with asthma, right?
yeah.
I mean, just to see things like that are amazing, right? But anyways, what I love about it is the pursuit of human achievement. There are things where some of this stuff gets commercialized. I like the Olympics better when you didn't have professionals in it. And obviously, you have some countries that back in the amateur days were heavily subsidizing their amateurs in ways that other countries weren't, and all that type of stuff. But it's always so amazing to see this.
Yeah, no, I agree with you on that. I mean, that's the one thing I'm not a big fan of in the Olympics is the basketball because we've got LeBron James playing basketball, and I think Olympics should be amateurs, right? I've always felt that way, even when I was competing back in the day. That there's amateurs and there's professional, and those should always kind of be different. And I think you kind of lose something when you start bringing professionals into the game.
Well, I mean, I think you do because I
That's
think
just personal. You may or may not agree with me. It doesn't matter. It's just my personal opinion.
Yeah, no, and I'm there with you. And I think for me, it's just because, look, the professionals get, every day of the year to get paid a ridiculous amount of money to do the sport. Where for these amateurs, this is their moment, right? This is their ability to really prove what they're able to do. And, you get a LeBron James or a Kevin Durant or whatever who comes in where you're just knocking out, some aspirational guy trying to get in.
Yeah.
So anyways, what I'm kind of trying to put my finger on here is human achievement. And I read this article, or sorry, this letter that Steve Jobs had written to himself. I think he wrote it to himself the year before he died. Have you ever seen this letter, Lance?
Oh, yes, I did.
Okay, I'll just read it here for folks that are listening on the podcast. But yeah, apparently he wrote this letter to himself about a year before he died, and it goes like this. It says, "I grow little of the food I eat, and of the little I do grow, I do not breed or perfect the seeds. I do not make any of my clothing. I speak a language I did not invent or refine. I didn't discover the mathematics I use. I'm protected by freedoms and laws I did not conceive of or legislate and do not enforce or adjudicate. I'm moved by music I did not create myself. When I needed medical attention, I was helpless to help myself survive. I did not invent the transistor, the microprocessor, object-oriented programming, or most of the technology I work with. I love and admire my species, living and dead, and am totally dependent on them for my life and well-being." And I think this is really, I just think it's really meaningful and inspirational that a guy who is one of humanity's biggest achievers. I mean, he's definitely made a bigger mark on humanity than most people alive, and was known for his own outsized ego. Actually did have the humility to recognize that, like, look, everything I do stands on the shoulders of what others have done. Whether it's directly the stuff that I use to express my genius, or whether it's just the mundane, like just feeding myself, right? And I think that that's really important perspective that, as we get inspired by watching, the Olympics and what one person's able to achieve, of course, yes, they are the ones that are achieving this, but in almost every case, they've had, support behind them, whether it's families, whether it's sponsors, whether it's just seeing another great athlete the generation before setting an example of what's possible and inspiring them to move, right? So I think there's a lot that we can take from that. From here, I just think it is, we should all maybe try to do a little bit of a better job. I certainly am, of just trying to have respect and compassion and gratitude, really for humanity itself, but also just the people around us, and realize that we're all in this together, but we all have our own contributions to make to the greater story that's going on here. So none of us is so insignificant that we can't make a difference, and none of us is so significant that other people don't matter, right?
No, I mean, look, and this is why, I was, it's so easy today with Twitter and Facebook and, YouTube channel, comment sections or whatever, just to be mean, right? It's just to say things that are mean, downgrade other people, whatever it is that you don't even know, right? Because there's no consequence. It's all anonymous. You can just hide behind the screen name and say whatever you want to say. But, what's important is to understand that, everybody is important. Everybody has significance. Everybody has a contribution. And just because you don't agree with them doesn't make their contribution to the world of whatever it is any less significant. And we take so many things for granted, and half the stuff that people say to other people, they would not say. I would forget that. 90% of stuff that people say, they would not say to somebody else if they had to say it to their face.
Oh, and the internet, absolutely.
Yeah. And I think we should all take back, and just for a moment, the internet could be such a better place if we would just all stop for a moment and say, before we type something, say, would I say this to their face? And if you're not willing to say it to their face, don't say it. Just don't say anything. Adam won't have any comments in his YouTube channel, but just don't say it.
Be fine. And Lance, I would say, yes, all that's true. I would say, but take that same attitude outside of the internet, right? Like, when you're in town, you're at the grocery store and you're in a rush and your mind's occupied by other things, but you're bustling through the grocery line, whatever, like, take a moment to thank the person who's bagging your groceries or ringing you up or whatever. Like, everybody plays an important role, right? And yeah, you might be a fantastic CEO or doctor or whatever, but like, you got to eat, and these people are part of the process that's helping you do so.
Exactly. No, I mean, it's my wife always gets frustrated with me because, every time we go somewhere and, I open doors for other people, and she'll be like waiting for me inside, and I'm holding the door open for other people to go in or out, whatever it is. Always say thank you. Hey, I appreciate you, whatever it is. And she's like, would you just come on? But look, a little kindness goes a long way. It's so easy to be mean. It's so easy to be dismissive. But being kind to other people, it takes zero cost to do that, but it yields huge returns. And you'll be surprised how many people, if you just walk up to the person bagging your groceries, thank you, I appreciate you very much for doing that. It'll make them smile almost every time, because nobody else is thanking them. They're just grabbing their groceries and going on about their way. But a little bit of kindness pays huge dividends.
Well, and that's what I think is so meaningful of this letter coming from Steve Jobs, because he was not a kind man, or at least he was not known as a kind man. Right. And I actually have a couple of Steve Jobs stories that I'm going to dial through real quickly, if you don't mind. So my path crossed his a couple of times. The first was, I was in my summer in business school, and I ended up staying out in the Bay Area. I was working for Anderson Consulting back then, which became Accenture. That was my summer internship. And one of my roommate's girlfriends was working for a media production agency at the time, and they got the contract to do a commercial for Apple for the new iMac. And they were doing a casting call, and they needed an MBA type that they wanted to have in the commercial. And they asked her, "Hey, do you know any actors who could be an MBA type character for us?" And she said, "I don't, but I know an actual MBA who's around this summer." So I actually was in an Apple commercial. Crazy. Not one that made it to TV, but if you went into like a Best Buy or a Fry's or a Circuit City or whatnot, it would have been one of the ones that was running, on the computers there. And it's totally embarrassing. But now that I've admitted it, I'm sure people are going to go out and search for it. I'll make it easy. If you, I'll send it out in the email that goes out the day this video goes out to my Substack list, the summary email. So folks, if you don't already subscribe to Substack, go subscribe now. It's totally free, but you'll get to watch this video. It's called The Simplicity Shootout, where basically they have me setting up an HP, like the latest model HP, versus I think like a 9-year-old and a dog. And of course, I get my butt kicked by them in terms of, it was so much easier for them to set up the iMac because it was so simple. I'm pretty proud with the time, just FYI, that I had in setting up the HP. But yeah, they crushed me by like two or three. It was like 2 or 3 times longer than they were.
And after that commercial, they stopped making the iMac, but I'm not saying.
Yeah, no. I mean, that's when it really that introduced the iMac to the world. It really started a whole
Maybe that's why HP went down the tube. So one or the other.
One or the other. Sure. Okay.
Whatever it is, it's your fault.
I probably brought HP down with that. Yeah. But what was interesting from that is when I went back to school in the fall, they were, Stanford would bring in big speakers, and they just happened to be bringing in Steve Jobs. And he was up on stage and everybody was taking their seats. And, he was sort of projecting this like, "Don't come approach me, bro" vibe. But I was like, look, if I'm ever going to talk to him, now's my shot. So I went up and, stood next to the podium to see if he'd acknowledge me. And I could see him seeing me out of his peripheral vision. And he kind of has this scowl like, who's this kid who's coming to annoy me? And he finally just turned to me and said, "Yeah." And I said, "I'm so sorry, Mr. Jobs. I just want to introduce myself. I'm the guy from the Simplicity Shootout." And I could just see his face like, "Oh, hey, yeah, I recognize you." Right. So that was kind of my fun first intro to Steve Jobs. That lasted all of 3 seconds. But I got to bask in his sunlight for a brief moment there. I then saw him probably a year later, where I was living in Palo Alto at the time. My younger brother came and visited me. We went to the bookstore, there was a bookstore right across the street from the first Apple store. The first Apple store was there in Palo Alto, California. So I was in the bookstore. My brother was waiting for me outside. And as I was paying at the register, I noticed there was this really striking woman standing right next to me. And so, I was paying, seeing her out of my peripheral vision. I turned to take a look at her and realized standing right next to her was Steve Jobs. So this was Steve Jobs and his wife, right? So I paid, I went out the front door, and I was passing my brother, and I said, "Hey, don't make a big scene, but Steve Jobs is about to come out here with his wife." And they walked out soon after I did, and my brother didn't get a good look. And I said, "Well, it looks like Steve just went into the Apple store there. You should go see Steve Jobs in the Apple store." So my brother goes in the Apple store. He's there for a couple of minutes. He comes back out and he says, "I don't think that was Steve Jobs. Or if it is, he's a colossal jerk." I said, "Oh, that sounds like Steve." And he said, "Yeah." He said, "I went in there, and this guy was the Apple store had been open for like maybe a month, maybe not even quite. And Steve Jobs had pulled just one of the floor sales clerks, like a junior level guy, and apparently was just hammering him with questions about the specifications of all the products that are in there. I guess trying to see how much this guy actually knew the products. But it's probably like back at the day, like a $12 an hour type employee. And Steve Jobs was just crushing him under this crucible of like, "Well, do you know this? Do you know this? Do you know this?" So anyways, I think that kind of showed what Steve Jobs was like in his own atmosphere, just such an incredible demander of quality at any point along the stack of anything related to Apple.
Yeah.
And I'll tell my last story here, which is I saw him in the last year of his life. So this would have been probably after he wrote that letter to himself, again in Palo Alto. which is where Steve lived. I was in Whole Foods and I was walking by the like vitamins and supplements row and saw Steve there. And initially I didn't recognize him, sadly, because he was just so frail. I mean, at this point, you know, he had pancreatic cancer. I mean, it looked like I could have just lifted him up with 2 fingers at the time. And he was going through and he was looking at, you know, whatever supplements. And I remember being shocked and saddened at how frail he looked. But also, again, just sort of taken aback by like, Jesus, this is Steve Jobs. Like this guy could have an army of doctors out there researching everything on, you know, on his benefit and bringing to him whatever he needed. But he was still out there doing his primary research, doing his own shopping, trying to figure out exactly what combination of you know medications might be able to help him. It was really bittersweet. You know, it was seeing this guy, you know, exercise again, the genius that made him who he was. But it was very obvious that unless some sort of medical miracle happened, he was not long for this world. And of course he wasn't. So anyways, at the end of the day, I try to take from my interactions with Steve and from that letter is to celebrate the greatness of the individual while having a lot of gratitude for, you know, the collective support that you know, humanity can and oftentimes does give itself.
Well, can we get to the important part? Because everybody wants to see this commercial, including me.
The iMac superior performance.
The problem, Lance, is I don't know if YouTube's going to allow this thing anymore. If it's going to give us copyright infringement if we show it.
Maybe, but that's you.
Taggart, age 26. You will be assembling a Hewlett Packard.
This is Adam in 1998.
As I said, kind of
That's
embarrassing.
all anybody wanted to know right there.
Yeah, thanks for bringing that up.
Well, you should know better than to bring something like that up when I'm sitting in front of Google.
Yeah, I know. I was definitely opening myself up for all that, and well deserved, you know. And definitely a different part of my life. And I, as folks can probably tell, you know, I looked quite different. Had the glasses back then, and that was before I really gave myself the permission to really make working on my health and fitness a priority. Back then, you know, we've talked a lot about this, Lance, but I always would sort of tell myself, look, I don't have time to take time for myself because I've got to hit these goals. And it wasn't for probably another, I don't know, 5-10 years after that I had the maturity to say, hey, look, if I want to be around to support the people that I want to support in life, I got to take care of this body so that it's able to do that.
Right. No, that's right. And again, that's why, you know, we talk a lot about health and fitness here, you know, from time to time, you know, eating right, exercising, those four things, because it's great. You know, and look, I have this conversation with our clients, you know, more often than not, which it's great to have money. It's great to be invested. But if you're spending if you're Steve Jobs and spending your entire retirement in and out of hospitals, then what was the point of building all the wealth, right? The whole reason you build the wealth is so you can enjoy your retirement. But if you don't take care of yourself and you spend all of your retirement years in and out of hospitals, in and out of surgeries, you know, what was the point, right?
Exactly. So, you know, just to put a capstone on this, make the most of what you got, both your talents, your opportunities, and the times you have here on this earth. But also take the time to be grateful, you know, grateful for having those opportunities and those resources, but also grateful for, you know, everybody who powers the ecosystem that you're able to leverage to try to pursue your own greatness. Okay, well, as we start to wrap up here, folks, if one of the things in the universe you're most grateful for is getting a chance to hear Lance on this platform every week, please let him know by hitting the like button, then clicking on the red subscribe button, as well as that little bell icon right next to it. As a reminder, you know, especially if you're looking for help on navigating the path ahead, especially if it takes the shape that Lance thinks it might, that he's laid out for us here. Highly recommend most people here should do that under the guidance of a good professional financial advisor who understands and takes into account all the things that we've been talking about. If you've got a good one who's doing that for you, great, stick with them. But if not, consider scheduling a consultation with one of the financial advisors that Thoughtful Money endorses, perhaps even Lance and his team there at RIA. To do that, just fill out the short form at thoughtfulmoney.com. Only takes you a couple seconds, and the financial advisors will be in touch with you hopefully within the same day that you fill out that form. Also, while you're there at thoughtfulmoney.com, like I said, don't forget to hit the newsletter link at the top, especially if you want to get the full video of the Apple commercial. And also a reminder that premium subscribers, they get the benefit of our weekly Macro Pass service. And this week's Macro Pass contributor is Darius Dale. So I mentioned his video is going to come out the day after this one. It is packed with a bunch of charts. You're going to get all the charts that Darius walked through in this Macro Pass, as well as one of his weekly notes from this past week. So a ton of data coming in this week's Macro Pass contribution. Last, before we wrap up, Lance, I'll give you the last word as usual. I just want to give folks a heads up that we are locked in for the Thoughtful Money Fall Online Conference. I think I've given a little tease of the date in the past, but it's going to be Saturday, October 19th. The faculty for this event is coming along amazingly well. We're still adding a few names, but we've got Lacey Hunt, who will be doing the kickoff keynote as usual, Stephanie Pomboy. I'm going to have former FOMC voting member Thomas Honig there. He's going to be interviewed by Danielle DiMartino Booth, who used to be an advisor to the Fed. Darius is going to come and give us the latest on his models. Again, this will be several months from now. Brent Johnson of Dollar Milkshake, Michael Pinto, Melody Wright on the housing market, Rick Rule on resource stocks, Mike Leibowitz, Lance's partner there on bonds. We're going to have Stephen Bavaria, who's the income factory guy, who's going to help share the latest assets that he's looking at in terms of building a income producing portfolio, but that also has the potential for equity-like appreciation. Obviously, of course, we're going to have our advisors like Lance and the guys from New Harbor and Jonathan Wellham. There's one or two more slots of some big names that I'm hoping to land too. Hopefully over the next couple of weeks, I'll let you know who those folks are. So not driving ticket sales just yet, but I want to let you know that all this is coming. Again, as Lance has said too, it's probably going to be a little bit of a more turbulent fall than we had earlier this year. So this is going to be an important time to really see where the puck is headed. And just a reminder that premium Substack subscribers will get $50 off the ticket price for this. So that's just one more benefit you get from your $15 a month. All right, that's it. Lance, thanks so much for another great week. I'm going to let you have the last word as usual.
No, that's it. Look, I don't think we're out of the woods just yet on market volatility. So just, again, use this rally to rebalance some risk. Doesn't mean sell everything, but just be a little more cautious here. And look, maybe I'm wrong. Maybe everything works itself out. We just go running back off to new highs. If so, it's pretty easy to put capital back to work. So you never go wrong by being a little bit cautious.
All right. Words to live by. Lance, thanks so much, buddy. It's been a great week. Look forward to seeing you next week. Everybody else, thanks so much for watching.